Good morning and welcome to this Wednesday, January 4th, 2023 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. First of all, Happy New Year. For those of you that didn't listen into my show yesterday over at Stock Charts, 2023 is here. The market kind of started off the way we performed in 2022. We did get off to an early start, very early, good start. But then the selling kicked in. We saw mostly selling in the morning, which has been one of the features of 2022. And then we rallied a little bit into the close. And I've got a chart I'm going to show you. For those of you, for anybody who's been following the show, you know that I've done a lot of analysis of the QQQ and the spider on an intraday basis, just to show a breakdown of how they've traded during the trading day. And I actually went back another year and did it to 2021. And I want to show you the difference between those 2 years, and we'll do that in just a little bit. Today's session is probably going to be shortened instead of the usual 30 or a little bit more than 30 minutes. Might cut it back to about 15 minutes. And the reason, I've been under the weather for about the last week or so with a cold. And we've got our huge event on Saturday, Market Vision 2023, which I invite everyone of you to attend. I think there's going to be a tremendous amount of information that you may not be aware of. Some of it might be a refresher. And even for those of you who follow me closely, some of this is probably going to be new. And so I want to make sure that everyone has a chance to see some of this information. So please plan to join on Friday. We'll make sure all of our members get room instructions. So mostly what I want to make sure is the folks of you that are not members at Earnings Beats, that you sign up. You do need to register to attend this event. So let me just hold on one second. Okay, here's our website over at Earnings Beats. This is the event I'm talking about, Market Vision 2023. You need to register. There's no credit card required. It's completely free. And even if you can't attend Saturday live, we'll send out a recording of the event that'll be time-stamped. You can kind of go in and look at what you want, or whenever you can, whenever you have time and it's convenient. Try to make this as easy as possible. Obviously, no cost. So you don't have to worry about an expense, and you can watch live or the recording in the comfort of your own home or at Starbucks or wherever you happen to be. So it's really a great event. It's one of the ways we give back. It's a huge event. We have 3 folks joining me from Stock Charts. Dave Keller, who you probably know, is the host of the Final Bar if you follow any of the shows over at Stock Charts TV. Dave is the stockcharts.com chief market strategist. Good friend of mine, and like I said, host of the Final Bar over there. He's going to share some interesting information. Also, Julius DeKempenaar, if you've ever used the RRG charts, which is a fascinating visual of how the sector rotation is taking place. Julius created that. He's going to be there on Saturday to talk about sector rotation and how important that is going into 2023. And then my good friend, Grayson Rose, also will be joining. Grayson, when I first started over at Stock Charts many years ago, Grayson was the host for one of my shows. And so we had a lot of banter going back and forth on our shows and got to be really good friends. And Grayson's a great technician as well. Very, very disciplined in his approach to the market. And that's one of his strengths for sure. He's going to be there on Saturday. We've got a great lineup, tremendous information at zero cost. You need to be there. Make sure you do click on that link where you can register. All it takes is a name and an email address. And while you're there, scroll down. You can read some of the information about us, what we're going to be talking about, our bios and so forth. Also, check out, if you haven't been following me for very long, check out this recording, this video recording, where we talk about, well, actually, it's more of an audio recording, but this is where I've given some prior forecasts for the last 3 Market Vision events. I think you might be surprised how accurate those 3 were. I don't do anything special. I don't have a crystal ball. I just combine everything. I look at the fundamentals, being a former practicing CPA. I look at the fundamentals. I look at the technicals. I am a historian of the market, as you know, and as I'll show you when I analyze the QQQ for you in just a couple minutes. I love to analyze. Love to analyze. It's probably my favorite thing to do with the stock market. I'd really do everything I can to try and figure out what makes it tick. Anyway, I combine that. I then throw in some perspective and just some plain old common sense. It's hard to step back from the market when you're being told every single day how bad things are. It's really hard to take a step back and say, how bad are they? A year ago, who was telling you how bad the market was? Nobody. We were at an all-time high. A bunch of cheerleading going on. I said we had a cyclical bear market on our doorstep, 20 to 25% in 6 months, 3 to 6 months. We went down 23% in 5.5 months. Again, I don't have a crystal ball, but I pay attention to what matters in the market. I'll give you my forecast, 2023 forecast on Saturday, completely free. Anyway, check that video out. I think you'll be impressed some of the calls from the past few years. Anyhow, all of that takes place this Saturday. I really want to make sure you're signed up if you're not already. Again, you don't have to be there live. If you have something else planned, sign up and get a copy of the recording. All right, enough of that. What I did here, I've got the major indices up here showing you the action on Tuesday to open up the year. And you can see it wasn't a particularly good day. I mean, the NASDAQ, you can see down 0.75% once again, leading to the downside. That was a theme in the fourth quarter, especially last year. And it continued into yesterday. So we'll see whether or not that's something that we have to continue dealing with. But for right now, we absolutely do. But down here on the bottom, what I did is I pulled up 5 of the worst performing industry groups in the last quarter. These are the groups. If you're wondering why the NASDAQ is underperforming the S&P 500 and the Dow Jones, a lot of it has to do with these 5 groups. You've got automobiles. Again, yesterday, there was some mixture. 3 of these were down, 2 were up. Excuse me. 1 second. Okay, sorry about that. That was a little cough break. Anyway, 2 of these were up yesterday. Internet stocks, broadline retail. Amazon rebounded. We saw some decent movement in the internet space as well. And by the way, internets love the month of January. It would be really unbelievable given how weak they were in 2022 if they just suddenly come back to life in January. But historically, can't rule it out because that is the best month of the year for internet stocks. And it's the best month of the year for the NASDAQ. Since 1972, we're talking 50 years, the NASDAQ has averaged gaining, I don't have the number right in front of me. I want to say it's like 2.3 or 2.4%. That's been the average gain in the month of January since 1972. The S&P 500, by contrast, has gained just over 1% in the month of January over that same time frame. So the NASDAQ goes into this year underperforming really badly. And yet now we go into January, and this is when we start to see the NASDAQ perform better than the S&P. I'm just pointing it out. I'm not saying it's going to happen. It hasn't happened every year. And certainly we're not looking technically like it's going to happen right now. But that's the history. I want you to be aware of it as we go into January. All right. But look at the last 3 months. I mean, automobiles have been horrific. If you've been following Tesla or if you own Tesla, you know this has been a very, very weak stock in a very, very weak group. Honestly, for the long term, I think it's setting up as a great opportunity. But in the short term, I don't know how much lower it goes. I wrote an article recently on Tesla that it broke down out of a head and shoulder pattern from about the $200 level. And when it did that, it measures down to roughly 100. And we've gone from 200 to almost 100 in a very, very short period of time. I think Tesla was down to 104 and change at its low yesterday, rallied back to 108. Currently, we are seeing, I didn't even talk about this, I don't think, at the open, but futures are higher this morning. We've still got another 20 minutes to go or whatever till we get to the opening bell. But last check, Dow futures up 125, S&P 500 futures up nearly 20, and the NASDAQ futures up 75. So on a percentage basis, it does look like the NASDAQ's going to get off to a better start. By the way, we saw that yesterday. The NASDAQ was up more at the open. And during the day, it actually shifted. And by the close, it had underperformed the other indices. That's intraday rotation away from the NASDAQ. That's not good. So again, we're gapping up today. It looks like we'll probably open up a little bit stronger on the NASDAQ. Can it hold it? The U.S. 10-year Treasury yield down 12 basis points this morning, 3.67%. So we're seeing a big drop in yields again over the last couple of days. You would think that would spur the NASDAQ. And I can tell you my biggest mistake in 2022 personally, I did really well in the first half of the year because I was bearish. Market went down. Even when we bounced, I said it wasn't going to last. Market was going to, it just looked like all my signals were saying we were going down. And we did all the way through June. I called a bottom in June and I changed my trading strategies. When I call a bottom and I think the market's going back up, I don't short, period. And because I believed rates were going to come down, I focused most of my attention in the second half of the year on the QQQ. If I'd done it on the spider, I would have done a lot better. But I focused on the QQQ because, again, that's what my signals were telling me. But what actually happened was rates came down. That should be a huge bonus for NASDAQ stocks. The high growers, rapid growers on the NASDAQ should do much better in a declining environment. Well, when rates started dropping early, like back in June, July, we did see the NASDAQ perform well. And I did pretty good. Personally, I did well through about the beginning, maybe it was later in August, probably around the Jackson Hole speech. And from there to the end of the year, I did not do well in the market personally, trading, because I was always trying to trade the QQQ. And what happened is rates ended up going back up. And I was pretty, I was okay for probably a little while. I was out of the market a lot. But when rates started coming back down, I was in the QQQ and I traded it pretty heavy and with leverage several times probably in the fourth quarter. And I lost pretty much every time. And the reason was rates came down, but it didn't result in outperformance by the QQQ. The QQQ badly underperformed in the fourth quarter. Really a shock to me. I'm still surprised. And it's something I'm thinking about as we go into Saturday, trying to figure out, my forecast, what I believe based on the way things have been trading. And what does that mean? What does it mean that rates came down and the NASDAQ continued to underperform? We don't typically see that. I'll talk more about that on Saturday. Anyhow, these were the groups in the second half, or the fourth quarter, I should say. And most of these groups tend to perform well in the fourth quarter, by the way. They did not in 2022. I mean, you can see them. These were the last 3 months right here. 3 months, 6 months, 5 months, whatever it is. There's your Amazon effect in the broadline retail. There's your Tesla effect. Here's your Apple effect in the computer hardware group. Here's maybe a little bit of Google and some of the other internet stocks, Meta platforms. Those stocks that got hit in the fourth quarter, they did start to rebound. You can see that they actually had a higher low at the end of 2022 than where they were back at the beginning of November of 2022. So we did see some strength there. And then media agencies also very, very weak over the last 4 or 5 months. So it was pretty consistent. I mean, the S&P went down, but it held up. So let me just say this, and I will go a little bit more than 15 minutes this morning. I'm feeling okay so far. But let me just say that, when you're looking at the major the highest market cap companies like Apple, like Tesla, like Nvidia, like Amazon, when these companies are all underperforming, it should drag the S&P 500 down to new lows. Apple set a new low. Tesla set a new low. Nvidia set a new low. Amazon set a new low. All these big cap companies, the ones that are most heavily influencing the direction of the S&P 500, all went to new lows, and the S&P did not. Now, I know some of you know that I talk about sustainability ratios, and from the questions I've received, especially in the second half of last year, I think you misunderstand, some of you misunderstand the way I use those sustainability ratios. I'm going to move into that here in just a second. Here's the 10-year Treasury yield. Let me get you an update. So this is where we are right now. Again, rolling back over below the moving averages. Now I'm starting to lose my voice a little bit. I think I'm getting too excited here. So I will cut it a little bit short. But what I want to do is I want to show you, let's pull up the S&P 500, and I'll just pull up a couple of these sustainability ratios. Let's go with, we'll go with the QQQ spider. Let's go with XLY, XLP. You can only imagine what that looks like. XLY heavily influenced by Amazon and Tesla. So that's going to be an ugly, but we'll look at it. And then let's look at IWF, IWD. That's the large cap growth versus large cap value ETFs. All right, and let's go back. Let's do 2 years here, just so we'll get the last couple years. So the S&P 2021, great year. 2022, bad year. Pretty easy. QQQ versus a spider. I mean, the QQQ held up. They kind of went hand in hand through most of 2021, but you can see the NASDAQ badly lagged in 2022. The XLY, XLP was breaking out late in 2021, but when we set that final high on the S&P, it was down. And if you recall from last year, hold on one sec. Okay, so if you recall from last year, one of the reasons, not the only reason, but one of the reasons that I felt the market was topping was that the S&P 500 was going higher, but the stocks, the primary stocks that helped to lead the QQQ higher were starting to roll over. So some of the big names, the XLY versus the XLP, that's Amazon and Tesla primarily leading that move to the downside on a relative basis to this consumer staples group. In the month of December of 2021, staples went up 10%. Discretionary was flat. And the S&P 500 went up. That is, I can't tell you how rare that is, but it's a major warning sign. The S&P 500 breaking out with leadership from defensive areas, from value-oriented areas. But notice what I'm doing. I'm looking to see if the breakout in the S&P 500 is sustainable to the upside. And my signals here were saying no, it was not. Every one of them were really turning lower by a significant amount. They were not continuing to go higher. Now, what a lot of folks are saying right now is, well, look at your ratios. They're going to new lows. But it's not whether they go to new lows, it's whether the S&P goes to a new low. I'm trying to determine if the move on the S&P breaking down to a new low is sustainable or not. So when these ratios would come into play would be when we set a new low. If you go back to the low closes at the beginning of October, right here, the QQQ and the spider had not broken down. Here, the XLY, XLP had not broken down. The IWF, the IWD had not broken down. There were no signs at that time that the S&P 500 move to the downside was sustainable. Then we rally back. Now you can see these ratios are continuing to go down. Well, what's that telling me? It's telling me that money is rotating away from some of the key growth areas. No doubt about it. There's no denying that. I'm not trying to, forecast this rosy picture on the stock market right now, because the S&P 500, until these large cap stocks start to turn back up, it's going to put a lot of weight on the spider to try to go higher. But you have to consider the flip side. If all of these high, heavy market cap weighted stocks like Apple and Tesla and Nvidia and Amazon and Google and AMD and all these stocks, Microsoft, even though Microsoft's been doing better, than some of these others, all of these stocks have been going down. How is the S&P going up if the heaviest weighted stocks are going down? Well, it's telling me that all the non-heaviest weighted stocks are exploding to the upside. And I'll tell you something real quick here. We do a lot of research at Earnings Beats for our members. We create a lot of chart lists using the Stock Charts platform, and we provide those chart lists to our members to use in their trading. And so I have a strong earnings chart list, which just features companies that have beaten Wall Street estimates as to revenues and earnings per share in the last quarter. That's filter number one. Then they have to be liquid, so they have to trade so many shares a day. And then number three, they have to be somewhat compelling on a technical basis. Either they're part of a strong group, or they are a strong stock within a group, or maybe they've just been downtrending and they've been horrible and they had a better than expected report and they got a gap up, something that maybe suggests that there's a character change on the chart. Those are the reasons they go on the strong earnings chart list. Okay. After I do the strong earnings chart list, I then do a strong future earnings chart list. And the way I calculate that, I think, now I don't have it on this account. I've got a couple of stock charts accounts. I was going to show you the scan that I use, that I run. But basically what I do is I go back, I look at the scooter right now. If a scooter is above 75 right now, then it would qualify for the strong future earnings because relative strength is strong. If relative strength is strong, my thinking is, well, maybe the market's anticipating strong results in the future. That's why a stock is showing a high scooter score. Stock Charts technical rank, by the way, SCTR. That's what a scooter is. Anyway, but I also will go back and say, well, what do the industry groups look like? Because if I've got a really strong industry group, then I'll take the scooters over 75. But if I have a really poor industry group, like right now, autos, the only way an auto could get onto my strong future earnings chart list is if their scooter is over 90. In other words, I need to have really strong leaders in a poor industry group. And the reason I mention this is because I go through and analyze all 104 industry groups before I do the strong future earnings chart list. And I decide which ones look strong versus the S&P 500. Let me see if I can pull that up, the relative strength. I tried before I did the show, and it wasn't allowing me to pull some of these up, but let's see what we get here. Okay. So right now, this is the Dow Jones U.S. Computer Services Index divided by the S&P 500. And this is the relative chart. Down below is the actual chart. You can see that the computer services group's been going down. But in November, we got all the way back to the August high. That was good. And so what we're seeing is on a relative basis, this group is showing strength. Money is rotating into this group. That's how you outperform the S&P 500. So when I get a group that's got strong, the relative strength line is above the 20-day and the 50-day, and the relative PPO is above 0, I consider that a strong group. Now, if I look at something like semiconductors, we'll see the opposite. You can see the relative price action is below the 20-day, and it's below the 50-day. Or actually 20 week and 50 week. And the PPO, relative PPO, is below 0. So this is considered one of the weak. So if you're a semiconductor, the only way you get on the strong future earnings chart list is to have a Scooter score over 90. If you're in a strong group, you can get on this list by having a Scooter score over 75. In other words, if you're a pretty good stock, but you're in a really good industry, I want that stock. But if you're a decent stock and you're in a horrible industry, I'm not interested. You got to be a real leader before I would be interested. And so I go through and I analyze this. Every time I update the strong future earnings chart list, I look at all 104 industry groups. And I literally go down and see, and I say, okay, software is negative. AI is positive. This is electronic equipment. Computer hardware is negative. And this one's positive. Some of them are a little, they're hovering right around the 20 and the 50, and they're all kind of together. Let me see if I can find one of those for you that, really just, it's hard to say. Like this one right here, this is hotels. Price action just went below the 50, but the 20 is still above the 50, and the PPO is still positive. Well, if the last time I looked at it, it was positive, I probably would just leave it positive, because to me, it's not showing enough signs that it's definitely, it's kind of like if you watch the NFL and they do a replay, you're only supposed to overturn the call if it's indisputable evidence. Like you cannot make a mistake. Of course, they botch that up all the time, but that's a different story. Anyway, when I look at this, I don't see indisputable evidence that this is a weak group. I still see a positive PPO, 20 still above the 50. I mean, look here, we went below and it shot right back up. Here we went below, shot right back up. So I think as long as the PPO is above the 0 line and the price action is close to these moving averages, I'm going to keep this as strong. All right, bottom line, why I was going down this whole rat hole here. When I did this, I just updated all the chart lists for our members. We just sent that out yesterday. When I did this, 12 industry groups went from weak to strong. Do you know how many industry groups I had that went from strong to weak? 1. The only group that went from strong to weak was computer hardware. And you can kind of see the last time I did it, which was probably a little over a month ago, probably we were below the 20 was still above the 50, we were still kind of sitting there, and I'm like, I'll give it the benefit of the doubt. Well, when I looked at it this time, there's no benefit of the doubt. Now we are below the 20, which is below the 50 in the relative PPOs. So now computer hardware goes to the downside. But you've got other groups that are really strengthening in this market. You can't overlook that. Aerospace. Look at aerospace, where it was a month ago or 2 months ago, 3 months. 3 months ago, it was kind of like in nowhere, no man's land. Now, aerospace is now trading at its highest relative level to the S&P 500 since right after the pandemic. There was a rally in May where we got up to this relative level, and we just went through it. It took us almost 3 years for aerospace to break out. That's why I wrote an article recently in the Don't Ignore This Chart blog talking about Boeing and how I think Boeing could have a good year. And this is the reason why. Aerospace is going up. And if I pull up Boeing, I am making it the full 30 minutes, by the way, so I guess that's encouraging. But if I pull up Boeing, actually, that's versus the S&P. Let's do it versus its peer group. Look at Boeing the last 3 months. So aerospace has taken off, and Boeing is one of the leaders in aerospace. That's a stock that you want to be thinking about or be interested in. Leading stocks in leading industry groups. Anyway, I'm going to end it with that. While I still have some voice, I don't want to take it any further. Let's just, market's going to open here in 30 seconds. Oh, I wanted to show you the QQQ manipulation. I can't go yet. Never mind. We're going to talk for a couple more minutes. So here's the 2001 QQQ, and here's the breakdown. This is what I did. When I talk about how I like to analyze, I went back every single day for the last 2 years, and I got the price from the hourly chart on the QQQ at the opening bell, the 10 o'clock price, the 11 o'clock price, the 2 p.m. price, and the 4 p.m. price, the closing bell. And I got that for every day. and I broke down the trading of the QQQ by opening gaps. So if we take the opening gap from January 2nd, January 3rd, January 4th, and so on all year long, and we add up all the gaps up and down, here was the net, $52.66. So the QQQ gains 86 or $87 from the beginning of the year to the end of the year. 52 of it was on the gap. In other words, if you were not holding overnight, you weren't participating as much. The market was in a good mood, and we were seeing gap ups. Market makers were gapping up, and it was forcing folks to buy at higher prices. From the open to 10 a.m., it went up $20. 10 to 11 down $15. 11 to 2 up 11, and 2 p.m. to 4 p.m. that should be a plus sign. It was up to 18. So if you add up, or maybe let me double check that. 2001. I'm just looking back at my Excel spreadsheet. Yeah, it was up 18. So when you add these down, it will give you 86.65, or hopefully it will. All right. So essentially, when you're going up, you're gapping up and you're trading up in the morning. 72 of the $86. And that was a sign of a bull market. Look at what happened in 2022. The QQQ lost 81 points during the year. So basically just flipped from where we were. We went up, we went back down, we gave it all away. Opening gaps were down 24. Open to 10 a.m. is down $64. That's $88 down by 10 a.m. So think about that for a second. If you'd got into the market every single day in 2022 at 10 a.m. and you sold at the close, you would have made money. Not so much in the first 5 months of the year. That was a true distribution period. I'm going to talk about that more on Saturday. But the first 5.5 months of the year, there was pretty much selling all day long. Once we went to this new low in June, this was one of the reasons why I called a bottom in June. Money, look at it, was mostly gaps. Look at these huge gaps going down. Do you see how it's much different here? There's a lot of big red candles, just all day selling. Here, all of a sudden, we're starting to see these big gap downs. And then look at these hollow candles forming, coming off the lows. Then you move back down, a couple of gap downs, we hold, and then hollow candles. From June on, I've got spectacular numbers. Again, I'll share on Saturday. But just look at the overall for the year. Down 24, opening gap, down 64, first half hour, down another 20 from 10 to 11, and down 32 from 11 to 2. And up $62 in the final 2 hours of the day. If you bought at 2 o'clock every day, the QQQ, in 2022, and you sold at 4 o'clock, you just held for those 2 hours, got out, you had no risk overnight, you'd have made $61 on the QQQ. Now, the average QQQ price during the year was probably somewhere around $320. $61, that's like 20% gains. I find that fascinating. And in an up market, we went up 18 of the $86 in the last 2 hours, or last 2 hours a day. But here we went up $62 in a year where we went down 81. If that doesn't seem like something fishy to you, I don't know how to explain it. I don't know how to explain it any better. Market makers control the action, and we are subject to all the news, all the manipulation, all the folks telling us every morning how bad things are. And then we see those opening gaps, and what do? We sell. We panic. What do you do when you're losing a lot of money? You sell. Then we go down to these lows, and you know what happens at these lows? The put-call ratio spikes to a point where everybody's betting on the put side. And when that happens, we get rallies. Or how about option expiration? We're going to talk about all of these things. I've got 2 sessions on Saturday. You want to be there. I'm telling you, you want to be there. Anyway, I did make it the full 30 minutes. Actually, we're 35 minutes in, so let's see what the market's doing. We got a slight higher open. The NASDAQ, which had leadership at the open already, you can see it's starting to deteriorate again. Now, I haven't looked at any stocks, but probably some of those big cap stocks got gap ups and maybe they're pulling back here a little bit. I don't know. Or maybe the futures weakened and, they were just happened to be much lower before we opened. But anyway, that's what we got. All right, I'm going to call it quits. Thankfully, my voice held up pretty well today, better than yesterday, actually, when I did the recording for Stock Charts. Tomorrow, I'll do another show over at Stock Charts TV. Starts at 9 a.m. All you have to do is go to Stock Charts, click on Stock Charts TV. You don't have to be a member of Stock Charts, by the way, to listen into their shows. This is a free part of their site. So you can go in and check out my show at 9 a.m. tomorrow morning. Everybody have a great day. Happy trading, especially Happy New Year, everybody. Have a great year.